Make no mistake, the global debt market completely dwarfs the world's equity markets in both absolute size and structural complexity. Nominal coupon rates provide the headline figure, but omit the structural data required for a complete. Make no mistake, the global debt market completely dwarfs the world's equity markets in both absolute size and structural complexity. Nominal coupon rates provide the headline figure, but omit the structural data required for a complete valuation. A precise evaluation relies on three distinct pillars: the mathematical baseline of returns, the intricate legal indentures that govern cash flows, and the geopolitical frameworks of the specific issuer. To accurately price these instruments, we have to systematically map this ecosystem. That means starting with the bedrock math and layering on the structural realities of the market. Total return is a dynamic figure, determined by multiple moving parts rather than a static annual payout. This formula represents the holding period return, or HPR. It is the primary engine for calculating the actual performance of a bond over a specific timeframe. The int variable represents the specific interest payments, or cash flows, distributed to the holder during that period. Alongside that periodic income, we have PT plus 1, the market price of the bond at the end of the period. This tracks capital appreciation, or depreciation, which fluctuates constantly on the secondary market. By combining price action with interest income and dividing by the initial price, we get the total return ratio. Subtracting 1 from this holding period return gives us the holding period yield, the actual percentage gained or lost. A primary driver of these inputs is the bond's term to maturity. The market segments these into three categories: short-term money market issues maturing within a year, intermediate notes taking 1 to 10 years, and long-term bonds extending beyond a decade. The remaining life on that timeline directly impacts price volatility. The longer an investor waits to recoup their principal, the more sensitive the bond's market price becomes to interest rate changes. Therefore, the baseline mathematical return of any fixed income asset is dictated by its time horizon and the resulting volatility of its price. The theoretical math of HPR is often interrupted by the external legal forces found in indenture provisions. An indenture functions as a set of rules that physically alter scheduled cash flows. A standard straight-line timeline can branch off based on specific clauses triggered by the issuer. A callable provision allows the issuer to buy back the debt before maturity. If the timeline terminates early, the issuer pays a call premium to compensate the investor for the loss of future interest. This introduces reinvestment risk. Investors seeking certainty look for non-callable bonds or deferred call structures that guarantee protection from early redemption for a set number of years. Other indentures include a sinking fund. Instead of returning the entire principal at the end of the term, the issuer must systematically retire the principal piece by piece over time, reducing the ultimate default risk but altering the outstanding capital. Indentures also establish the hierarchy of claims if the issuer faces bankruptcy. The seniority dictates who receives payment first during a liquidation. Secured or senior bonds are backed by physical collateral, placing them at the top of the line. Unsecured bonds, known as debentures, rely strictly on the issuer's general creditworthiness. At the lowest tier of protection are subordinate or junior debentures. If the company fails, these holders only receive payment after all senior claims are satisfied. A bond's theoretical yield is only as reliable as the specific legal indentures protecting its timeline and its position in the capital structure. To manage this complexity, we categorize the market by its four primary issuer types: sovereigns, agencies, municipalities, and corporates. National governments issue massive volumes of domestic debt. The United States issues T-bills, notes, and specific inflation-protected securities, known as TIPS. Sovereign structures vary by country. Japan issues long and super long-term bonds, while Germany issues Bund bonds within a liquid market facilitated by the Bundesbank. Separate from direct sovereign debt are agency issues. In the U.S., these take the form of pass-through certificates from groups like Genema. Germany funds infrastructure through organizations like the Federal Railway and Federal Post Office. Shifting focus to the corporate sector reveals a denser subset of structural variations. Here we find structured asset classes pooling individual loans together, such as mortgage-backed securities and the highly complex collateralized mortgage obligations. Corporations also issue zero coupon and deep discount bonds. Because they pay no periodic interest, investors buy them at a steep discount to face value. However, the holder is still liable for taxes on the implied interest each year, even when no cash is received. Risk profiles in the corporate space are explicitly graded by rating agencies. Any issue carrying a rating below BBB or BAA is classified as high yield or junk bond territory. Beyond domestic borders, geopolitical rules dictate international issuance. Foreign bonds are issued in a specific country's currency by a foreign borrower, like Yankee bonds, which are dollar-denominated, but sold in the U.S. by an overseas firm. By contrast, Eurobonds are underwritten by international syndicates and sold across multiple national markets, insulating them from the regulations of any single domestic currency. Sovereign legal structures and unique issuer types dictate the risk profile of otherwise mathematically identical bonds. This brings us to municipal bond market. Whether structured as general obligation or revenue bonds, these instruments are defined by their exemption from federal income tax. Comparing a tax-free municipal yield against a fully taxable corporate bond requires a standardizing calculation. This equation displays the equivalent taxable yield formula, which creates parity between different tax environments. We take the municipal tax-free yield, represented by I, and divide it by 1 minus the investor's marginal tax rate, T. This tax rate acts as the dynamic lever in the calculation. As an investor moves into a higher tax bracket, the comparative value of that tax-free municipal yield scales up dramatically against a taxable alternative. While municipalities carry default risks, private carriers like MBIA or AMBAC often insure these issues. This insurance raises the rating to AAA, ensuring a more active secondary market. Tax frameworks construct a parallel pricing universe. For investors in specific brackets, a lower nominal coupon on a municipal bond will out-yield a numerically higher corporate coupon. The complete analytical model establishes the baseline math with the holding period return, filters cash flows through the rules of the indenture tree, maps risk across the global matrix, and adjusts for the investor's tax environment. Bond performance is a function of the underlying legal contract. Yield analysis requires the simultaneous mapping of duration, indentures, and tax environments. Mastering this layered taxonomy is the prerequisite for advanced portfolio management, allowing investors to isolate true return in the global debt market.
Okay. Assalamualaikum semua.
Waalaikumsalam, Prof.
Everyone is talking about SpaceX's
Oh,
IPO, but it's what's happening after that that I'm excited about.
okay. Assalamualaikum warahmatullahi wabarakatuh. We start the class with the recitation of Kitab Al-Fatiha. أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين الرحمن الرحيم مالك يوم الدين إياك نستعين اهدنا الصراط المستقيم صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين. So how are you all today?
Alhamdulillah, Prof.
Okay. All right. Good. So we have Muawiyah here. We have Ahmad Nabil. We have Muhammad Amin. Okay, we have Muhammad Faiz, Fatia, Nadira, Alia, Diaus, Shakir, Siti Nuraisya, Ahmad Nizar, and Mama Adam.
Salam Prof.
Yeah.
I'm here also.
Yeah, good. How are you in Kazakh? Huh?
Uzbek,
In Kazakh?
Uzbek.
Oh yeah, Uzbek. Yeah, in
Yeah,
Uzbek. Huh?
Alhamdulillah, Prof. Good.
Good. So
I'm still at work right now.
yeah. Oh, you're still working.
Yeah, because right
Okay.
now we have like 12. evening.
12 in the evening.
Yes,
Oh,
Prof.
okay, okay. All right. So how's the weather over there?
Wizard?
The weather.
Yeah, right now it's cloudy. Should be like rainy, but here also panas. Panas lah.
Oh, panas. Oh,
Ah,
it's
like
not winter. It's not winter.
13 degree. 13.
13 degrees, not panas. It's very cold.
No, no, no. I mean, tiga, 30.
Oh, 30. Okay, it's
Yeah,
almost like Malaysia lah. Okay.
yeah.
So winter will be in December.
Inshallah.
Okay. All right. So welcome all of you to today's class. Where basically we are going to cover on the fixed income, which is bond or sukuk, okay, or sukuk in the Islamic bond. So I've shown you the video just now because I need to show it to you because not many of you have seen the video. All right, but I see that only 8 of you have seen. So that video is actually saying that when you want to invest in bond, okay, but it's not in Malaysia, yeah. That one is actually in term of US. So basically, there are 4 types of bonds. Okay, the first one is we have the government bond. Okay, we have to also in Malaysia. Then we have the corporate bond. We do have also corporate bond in Malaysia. Municipal bond. This one I'm not really sure about Malaysia. Okay, municipal bond. Municipal bond is actually tax exempted, okay? Whereas for the government and also for the corporate bond, it's actually not being tax exempted. So that's why you need to see if you invest, for example, in the US, okay, you have to identify, okay, what would be the difference, okay, when you want to invest in corporate bond or in municipal bond, okay? All right. So, and then we can also invest, okay, in the Euro bond, okay, or Yankee bond, okay. So basically, Euro bond is actually like it's actually being offered for any of us to buy, okay, from any country. So basically, that is actually the Euro bond. It is not actually being governed by any country. It's actually like an international governed, huh? It's national governed. All right, and then also for the what you call it, the bond, we do have some rating agency that actually rate the bond. Okay, for example, there are different rating agencies. We have the rating will be from AAA until to C. Okay, maybe or B, right? So you can have like 2 categories, which is the investment grade bond, and the other one is high yield, but we can call it a junk bond also, junk bond. It doesn't mean that it's a junk, but it is actually saying that it's actually have a high risk, okay, because the rating is actually below, I think it's below B, okay, right. Okay, let's look at the um okay, how do I want to get it out from here? Ah, not. Oh, here. Okay. So what I've actually explained just now is actually the whole thing lah of the fixed income market. Okay. So basically fixed income market is saying that you are targeting your return should be fixed lah, should be fixed. There's another bond that I forgot to mention just now, which is we call it the zero coupon bond. Okay, the zero coupon bond, which means that the bond is actually not paying any interest, okay, or profit. Okay, for suku is profit, for bond is actually interest. So instead of giving interest or profit, uh, the motivation to buy the bond is actually because you buy it at a discount, okay, a very large discount. So you make profit from the discount, okay, you make profit from discount. So any question before we start?
No, bro.
Yeah. All right. While we do need to understand about bond, because whenever you have your portfolio, okay, so um, you will have this the choice of buying the fixed income securities and also the equity, right? So we have the money market, fixed income, and also the equity market, right? So whenever we have like you want to have like a portfolio which is very very conservative, we will invest more, okay, in um the fixed income market, okay, fixed income securities. So then, for example, the what I call it, we can actually allocate, okay, our investment, maybe 50% in the fixed income, okay, then another 20% in the what I call it money market, then 30% only in the equity market, because we know equity market is have a high risk, right? So basically, when you have a higher allocation to the equity market, so we will have like a risky, okay, portfolio, okay, a higher risk compared to the what I call it conservative portfolio. So for conservative portfolio, normally we will have a higher allocation towards fixed income securities. Then we have another what I call it category whereby we call it like a balance, okay, portfolio or a moderate portfolio. So the balance might be 50% in the fixed income and money market, then another 50% maybe in the equity market. So that is what we call a balance portfolio. Okay. Then another one, we have like the aggressive portfolio. Aggressive portfolio, our allocation towards the equity market is large compared to the moderate or to the conservative portfolio. So we will, for example, invest or allocate about 70% or maybe 60% of our investment towards the equity market. Okay, so when we have a larger, what I call it, exposure towards the equity market, then we will have like potential to have a higher return and also potentially have a higher risk. Okay, so if we have like a 60% equity market, then maybe 30% in the fixed income and 10% in the money market. So we call this portfolio as aggressive. Okay, all right. Yes. Okay. Any question?
Ada, Prof.
Tak ada, Prof.
Now, we have actually discussed about passive management and also the active management. The passive management, which is you are trying to follow the market, you are trying to follow the index, you track the index. So the philosophy is actually you buy long term lah, buy and hold. Okay, you buy and then you hold, and then you want to actually follow the market. Okay, so basically, this is actually we call it the passive. So you buy and then you just hold. Then sometimes you do need to do rebalancing, yeah, for your portfolio. Okay. So the vehicle normally we buy the exchange traded fund, ETF. But for the active management, okay, the philosophy is actually you try to beat the benchmark or the market. Okay, so this is how you do it. Okay, this is how you do it. So basically, okay, you have to buy and sell, buy and sell, buy and sell. Okay, as and you try to find the maybe you can say unicorn of the what you call it, the of the stocks or stock market lah. So that you can actually beat the market. So if the market is providing you 10% return, you want it to be more than 10%. Okay, so that is actually active management. Okay, so basically, basically the hurdle is actually you have to make more lah, make more money for your portfolio. So whether you want to go for passive or active, okay, what do you think? Do you want to go for passive or you want to go for active management?
Passive tapi because I want to avoid the being fatigue with the chart and also the currency trend.
Again, you want to go for passive.
Because I want to avoid the fatigue from the
Okay.
buy and sell hustle. So
Yeah. Okay, so you don't want to have problem with this. You have to buy and sell. You have to make a lot of decision. Then you become fatigued, right? So, yeah, it's actually like that. So, for example, I'm going to give you an analogy lah. So this is like a minimalist. You know what's minimalist?
Simple life.
Simple
simple.
life, right? So, okay, maybe the woman can relate lah. Okay, woman can relate. So, for example, you want to go and you want to go for shopping or you want to go for that. So you have like maybe like different color of hijab, okay, or we call it shawls. Yeah, shawls. Do you use shawl or what? Shawls, right? Ah,
Bawal.
bawal is actually a shawl or is actually what? I'm not listening from the woman. Is it shawl or is it um
It's bawal, Prof.
oh bawal?
The minimalist is
It's not
bawal.
shawl lah tu. Oh, it's not called shawl eh?
It's called short, but the minimalist is bawal.
Oh, the minimalist is bawal. Okay. So, but you do have colors, right? You to match, okay, with your handbags or your clothes, right? So you need to have that match, right? Okay. So now if you look at sometimes this is gentlemen, so basically sometimes they only use a very simple, how I call it, color, white, and then the trousers maybe black, okay, or maybe blue, right? So every day it will be the same, okay? Every day will be the same. And some people say it's boring, right? So boring. There is no fashion or trend, right? But if you have that like kind of mindset, okay, basically you don't have to make decision for what color of clothes or whatever. Okay, you need um uh to wear on that particular day. So you have freed your mind to make bigger decision. Okay, to make bigger decision. So you are actually, because if you are trying to do it every day, you have to decide what color of clothes. Okay, this is what the philosophy of the minimalist lah. So you have to choose this color and that color with which handbag and so on. So basically, already um you have already what call it, use your mind to think about something which is not really really important at that particular time lah. That is the philosophy of the minimalist. But as normal, for example, a trendsetter or whatever, right? So fashion designers, that they have to think about that lah, because that is their career. Okay, but for entrepreneurs, okay, for people who have a lot of what I call it burden that they have to think. So they try to be minimalist. They don't want to think about what type of color of clothes that they have to wear and so on. So basically, if you look at the what I call it, the drawer, okay, of the billionaires, okay, they have a very simple wardrobe. Okay, very simple wardrobe. So the same thing as what you have mentioned just now. You don't want to do buy and sell because you don't want to have a fatigue, okay, decision, fatigue mind, lah. Okay. Okay, so you want to, but okay, maybe some of you want to go for active management because you want to overcome the market. You don't want to be getting like what the market are providing. Okay, So if the market is 10%, you want to be maybe 30%, 40%. Okay. All right. So in the market itself, yes, there are two type of what I call it fund managers or investors. One is actually passive, the other one would be active. Okay. Now let's look at the anatomy of a bond. Okay, the intrinsic feature. So basically, the first one is the principal value. Okay, the principal value, for example, this is 1,000. Okay, so when you want to buy this, you have to pay 1,000. So basically, bond or sukuk, you are actually lending, you as an investor, lending your money. Okay, this is conventional. Conventional, you are lending your 1,000. Okay, at the end of the day, you will have 5% coupon, so you will have 5% interest. Okay, and it will also have a maturity date. If it is 1 year, then you have 5%, which is 50 ringgit. Okay, 50 ringgit at the end of the year. Okay, and then the number four is actually the ownership type. So registered, track, centrally, or bearer physical position. So this is like the intrinsic features of a bond. Okay, so basically this is the conventional bond. But if for suku, okay, suku is actually a bit different because it will depend on the contract that you are using. So some of the bond, okay, a suku, they are using like mudarabah contract, musyarakah contract, okay, or maybe they are using wakalah, ujro, okay, they will be using like rental, okay, and so on, right? So the contract, okay, underlying the suku, the structure, making it Sharia compliant. Okay, right. Yes. Any question on that?
Prof,
Yep.
from the slide, we can see that the call out for from what is called is indenture provision is referring to call out for, ke, Prof? Ownership type.
Okay. So what's the question?
The indenture provision, is it stated in the bond or not? Or just stated in the contract?
No, this is the basic. Okay, the basic of a bond. Okay, basically for the indenture, there is like a separate, okay, separate contract that you need to uh to to be to be uh what you call it is actually to be furnished for you, okay, if you are the investor. So the indenture, there are a lot of indenture. For example, callable, non-callable, deferred call, non-refunding provision, and sinking fund. So basically indenture ni is actually like uh the thing that will actually um um if it is a normal bond or suku, it will be very simple. Okay, you for example bond, you give 1,000, then the coupon is 5%. Okay, maturity date is 1 year. Okay, then you will have 50 ringgit at the end of the year. Okay, but this indenture will have like the maturity modifiers. It will modify your maturity. It will modify your bond. Okay, for example, callable. So let's say the maturity date is actually 1 year. Okay, but 3 months after you have bought the bond, okay, the issuer say that, oh, I want to call back the bond. So they have this indenture provision if it is a callable bond. Okay, but if it is not mentioned as callable, the bond has to be matured in 1 year. Okay, the bond will mature in 1 year. So there is no provision for the issuer to call back the bond from the market. Okay, understand. So the same thing as the others lah. One is callable, the other one is non-callable, deferred call, non-refunding provision, and sinking fund. Now, for sinking fund, basically normally for a bond, for example, at the maturity date, okay, you have we as investor has invested 1,000, right? So at the end of the 31st of December, for example, 2026, the issuer will have to pay the coupon, which is 50 ringgit, plus the principal, which is the 1,000. right? Now, 1,000 is okay lah. The amount is not that big. Now, let's say, okay, the total value of the bond issued may be 1 billion. Okay, 1 billion. Okay, $1 billion. Okay, or maybe 1 billion ringgit. But if 1 billion rupiah is not that many lah. Okay, 1 billion rupiah is about 200,000. Okay, but if it is $1 billion, right, for example, then at the end of the maturity date, the issuer need to pay, right? So sometimes it is actually there is some issuer will be have some difficulties in paying the uh, paying the bond. Okay, this is very very true. Now I'm going to explain to you about this scenario in the maybe in Malaysia or in the other country, in US, in many other countries. If normally, okay, like let's say that a government issue a bond, okay, government, okay, Malaysian government because of the, for example, deficit budget, right? So the deficit need to be financed. So this normally finance the what call it deficit through issuing bonds lah, issuing bond. So let's say they issue bond maybe 10 years or maybe 5 years, maybe 1 year, right? So when the maturity date of the bond, this issuer, the government or the corporate, right? They need to pay back the principal. Now, if you look at the history of, for example, Malaysian budget lah, okay, there's only one time whereby we are having surplus. The rest of the years, the rest of the budget will be deficit, which means that we are issuing bond, we are issuing debts. Okay, right now, if we keep on issuing debts, where do you think we get the money to pay the debts? So what we do is actually normally what we do, the government or the many governments, they will actually issue a new bond to pay the old bond. Understand? Okay, you korek, then you dig, okay, then you dig another. No, you dig, then you what you call it, you pay, which is actually you cover the hole, then you dig another hole, which is a new hole. Okay,
And
so
you do
basically
profit
you are not paying. Okay, you are not paying the debt. You only creating a new debt. Okay, probably what the issuers do is actually only paying the interest or profit of the coupon of the bond or sukuk. Right. So to avoid, okay, so this is normally to avoid of not paying, right? Okay. You are using sinking fund. So basically, you are paying, okay, a certain amount of money before the maturity date, so that at the end of the maturity date, okay, you already finish paying the principal, right? So maybe let's say 1 year, okay, the last 4 months, okay, you pay like 250, 250 for the last 4 months. So at the end of the 31st of December, you don't have to pay that 1,000 because you already paid 250, 250, 250, and 250. Okay, but the problem that when they use this sinking fund, okay, at the 6 month, your principal has reduced. Okay. So when your principal has reduced, so basically you cannot get that 5% coupon lah, because it will be also reduced. Okay, 5% is actually on on 750 only. Okay. Then at the second month, 5% is on 500. Okay, then another one is actually on 250, then the last one only is actually being paid all. Okay, it's only you only be getting on the 250 principal. Okay, the 5% coupon. So that is sinking fund lah. Basically, it's not the same as sinking fund in the when you are uh, buying an apartment. So it's different. Okay. When you buy an apartment, there is a sinking fund. Okay, or you are renting, for example. Normally, when you rent, you don't have to pay the sinking fund because the landlord pay the sinking fund. When you stay in an apartment in strata, we call it title, right? Strata title. To apartment, we call it strata title. So you have to pay maintenance fee and also sinking fund, right? So it's different, okay? In the apartment terms for sinking fund. Sinking fund in the when you are staying in an apartment is actually for whenever there are what I call it a big maintenance that they have to do. For example, they have to maintain the lift. Okay, they will use the sinking fund. Okay, or they want to what I call it repair the roof. Okay, the rooftop or maybe the water what I call it apa apa dah water tu tank water tanks, right? Water tanks, so they need to use a lot of money, right? So that sinking fund is actually being used for maintenance fee. Basically is actually being paid for normal operation. For example, you hire a cleaner, you pay the electricity, which is normally daily operation. But for sinking fund, it's actually used for what I call it not normal, okay, not operational, but that need to be repaired or to be maintained. Okay, and also different for sinking fund also different for when you are doing business or okay, there are different name we use for sinking fund. All right, so we are clear on this, anatomy. Basically, it's very simple. Okay, except for sukuk, we need to have the underlying contract. Okay, which is need to replace the lending and borrowing. Okay.
Prof,
Yeah.
from the ownership type to what the difference between registered and bearer? Any different or any benefit to each type of ownership?
Okay. Yang ni different in term of whether you have the certificate, you have the physical possession, or it's actually being tracked centrally lah. Okay.
Oh,
All right.
okay.
So there is a different in term of that only. Okay, but for bond or sukuk ni, I haven't have the physical possession. Never. Okay. Because I don't actually invest in this sukuk. Okay. But when I buy, for example, the um from a unit trust, for example, in Touch and Go, okay. So I believe that I'm just a registered, okay, registered ownership, okay. I don't have this like the certificate, but normally nowadays they don't have this certificate, okay. Maybe it's actually digital, but it's actually like you have your name there, okay. But for a bond, normally you don't have the name, okay.
But it's
But
renting,
you, if you watch the World War movies, right? So they have this bond, right? This bond is actually like a certificate, but you have the possession. Okay, so you are the bearer, lah. Okay,
Alright.
so okay, you if you watch the movies, okay, they are trying. I mean, the Germans and the the US and the British. Okay, there's one movie regarding about this. I have forgotten the movie, but they are actually trying to what I call it to they duplicate the bond, okay, like a fake bond, and then they want to um what I call it flood, okay, the British market with the fake bond. So it's actually like a certificate lah. Last time lah when it was World War I, World War II. So we do have this what you call it the physical certificate. Okay. Nowadays I don't think we have this certificate. Probably, yeah. Probably they have this, do these have the copies of certificate, right? Okay, now we look at the debt. Okay, the bond market we can say is debt market. The sukuk market also normally people consider it as a debt market, right? Just to make it to classify it lah. But if you are using mudarabah, musyarakat, then basically it's not debt market, right? So basically it's equity. But to make it easier, I'm actually just trying to categorize all the fixed income as debt market lah. Okay, but if you look at as I mentioned before, right, musyarakah, mudarabah, right? So basically, it's not debt market. Okay, it is not debt market, right? It is equity, right? Um, but since we are actually using the what call it the conventional market, so the sukuk also fall into the debt market. All right. Now we can classify the debt based on the maturity date. Okay. For the money market, it's short term. This is we understand that for money market short term, and then the return is also not that high. Okay, not promising. Then we call it notes. Okay, which is 1 to 10 years. Then we have bond, which is more than 10 years. Okay, so this is how they classify it. So basically, sometimes some people also say that even it's actually 1 to 10 years, they call it bond also. But in term of um, the theoretical, we can just call it as a treasury notes, for example, or what, which is notes, and not as bond. Then we have the secured bond. Secured bond, which means that it's actually backed by assets, okay, or backed by mortgage. So we call it secured bond, right? So this is which is less risky because whenever whatever happen, if the business is not doing well, you still have the asset, okay, to pay the bondholders. Then you have the unsecured bond, we call it debentures, okay. Then we have subordinate debentures, which is we call it junior, okay. So junior debentures and senior, okay. So safe to higher risk, highest risk. So this is safe because um, you have backed by assets, or you have mortgage to back the bond. This is not being backed by any what you call it assets or mortgage, and then this is actually it is not backed by any what you call it asset, and also very high risk, probably because of the ranking of the rating, okay, rating maybe it's actually B, okay, below B, and so this is junk bond lah, junk bond, okay. All right. Okay, calculating fixed income return, okay, this is the holding period return, okay. This is the principal at the end of the period, okay, so which is T plus 1. This is the coupon or the interest, and this is the price or the present value, which is the T0 lah, right? So you want to calculate the holding period return, okay, holding period return. So basically this is actually saying that principal plus interest divided by your initial principal. Okay, so this is actually including your capital gain plus with your interest, right? So this is if you look at the stock market, for example, this is the price of the share, okay, at T plus 1, which is also including capital gain plus with dividend, okay? So then you divide by the price when you initially buy the stock, okay, the same, okay. So HPR is that. But how do you want to get what is the annual yield, for example, or the annual the yield? So you just take all this minus with 1. Okay. So 1 minus with 1, which means that you minus with the principal. Okay. You minus the principal back. which is PT, the initial principal. So that is what we call the HPY, holding period yield. So if, for example, this is 1.2, okay, 1.2, if this HPR is 1.2, you minus 1, so is that you are getting 0.2. 0.2 you multiply with 100, so basically you are getting 20%. Okay. Okay.
Okay, Prof.
So we have this global fixed income ecosystem. So you have the global bond market liquidity. So you can buy from federal government, okay, government agencies, municipalities, which is local, local. But I don't think Malaysian local state government also issue sukuk by themselves, okay? Right. But I'm not really sure about that, okay? Then we have corporation, then we have international issues, foreign bond and also Euro bond. Okay, this is the bond that you can buy. Okay. The participating investors, we can buy a smaller segment of direct ownership, and maybe institutional dominance, the major player, life insurance companies, commercial bank, property, and liability insurance, pension fund, and mutual fund. Okay. Okay. Now, when we talk about this, okay, we are talk about global bond market. So I want you, okay, we will take like uh 10 minute, okay, a 10-minute break for you to look at, okay, for you to look at the subprime crisis. Okay, subprime crisis. So subprime crisis, okay, and what it has to do with the bond market or whatever lah, okay, or maybe it's actually looking at derivative, okay, but I want you to do that, okay, within the 10 minutes. Okay, what time is now? Hmm.
3:31.
3:31. Okay, 3:31. Okay, can we discuss back about it? Okay, in 3:31. Is it sufficient? 10 minutes. Subprime crisis. Global subprime crisis. I mentioned to you to watch the video kan?
Yes.
Apa ni? The Big Shot, okay? The Big Shot, but you can watch the video later lah. But I want you all to do some what call it searching within the 10 minutes. So 3:45 we resume back and then we will have some discussion about it. Okay? 3:45.
Okay, Prof.
Okay.
My wife stopped trusting me because I never do the things I say I'll do. She just does everything herself now. I finally found out why.
Welcome to Crash Course Economics. My name is Jacob Clifford.
And I'm Adrienne Hill. And today we're going to do something a little different. We're going to explore one moment in history about how the 2008 financial crisis happened and the government response to it in the United States.
So let's get started.
Okay. Okay, what is your take about the subprime crisis?
Can I try?
Yeah.
Okay, subprime crisis started when the housing loan is given to the borrower with the bad credit or weak credit. At the time at the US, the interest is lower, and then when the borrower can access the financing for houses, a lot of them create the bubble in the house price. And suddenly, US have reset their interest and make the repayment become more higher. So they are default in the payment. At the same time, the borrower cannot sell or refinance their house because the sudden drop in the housing price. On the same time, the loan is packaged and become a investment product and be sold across the world. And when the borrower cannot pay, so make the investment product become less attractive and drop in the price. Is that
Okay.
correct? Okay.
Thank you. Anyone else? Anyone else? No, do you understand or not? What the subprime crisis?
Understand a little bit.
Understand.
Same goes as Faiz explained about the bubbling of the house mortgage, and then the CDO and also the CBS help to coverage the interest they need to the financing need to be paid, and then the AIG, one of the companies got falling down because of the too many bubbles that need to be paid because of the buyers cannot, because the buyer is the we call as the tak tak berkelayakan sepatutnya untuk applying the house. However, the company need to cover lah the things.
The woman? Anissa. They here. Fatia, Nadira, Alia, Noraisha. Hello.
Yes, Prof.
Okay. Okay. Fatia, representative for the woman. The rest, I'm not sure they are they there? Are they in the class or not? Fatia.
Prof, in Malay boleh ke?
In Arabic lah. Come on. Yes, you can answer in Malay.
From what I understand and what I read is about effect from the American, dia turunkan kadar pembelian rumah tu kepada masyarakat, bukan masyarakat, kepada rakyat American itself. So benda tu sebenarnya give a big effect to the to the economy, to the economy of American lah. So it is menyebabkan macam-macam apa ni, rate pembelian rumah tu semakin rendah dan orang ambil kesempatan membeli rumah flip tu. Jadi bagi efek yang agak teruk lah kepada American itself. Itu saja, Prof. The rest orang lain dah explain lah.
Okay, so basically there is like, okay, I'm just giving some idea lah. So mortgage industry, okay, property industry in the US, okay, it's actually booming, booming at that particular time. So the price of the properties keep on rising, okay, and then for someone who are working in the bank, okay, they are being paid by maybe commission or maybe salary lah. But normally by sales normally they try to they get their income from commission lah. Okay, commission, maybe broker, bankers and so on. So the more you sell, okay, the more you get lah, the more you get. So if you notice that when they the incentive, the motivation, okay, the motivation to getting more money lah kan. So the motivation is to sell more. So the banks, okay, has reduced they're becoming less stricter lah in terms of approving the loan. Okay, approving the housing loan. So someone who are working, not working also can buy a property. So if you watch the Big Shot, someone who's not working, someone who are working as informal economy, like being a striptease, okay, strippers, also can buy 3 houses, okay, during that time. So when they cannot pay back their loans, okay, so then it become the started of the bubble lah, okay. But on the other hand, these banks, okay, they have the incentive also to sell, okay, the loans, the liabilities to someone else, okay, to other parties. So basically, they don't care. That's why they are apa ni, the rules becoming less stringent, okay, in approving the loans, okay. So because they in their mind say that, okay, we can just sell to these toxic loans, to the toxic, what call it, not really paying, good paymaster lah, okay, homeowners. So they try to shift these toxic loans towards someone else. So they shift the risk lah to someone else by securitization. So you gather all these, what I call it, loans, and then you sell to someone else lah. So and the securitization is also being rated triple A. Okay, triple A, which is like a very good high value investment. Okay, and then it's becoming attractive, okay, because they'll give you, it's actually being packaged as a very good investment, okay, and then it becomes like demand, okay, from not only from the local market, the US market, but also in the international market, so in global market. So the previous slide that I shown you to is actually looking at the global market, the global bond market. But it does not only involve bond, okay, it also involve like the CDOs and so on, okay. So they sell, okay, for example, the bond, maybe it started from the bond, then it become a derivative from the bond, okay, it becomes derivative, so it becomes CDOs, it become another monster, okay. So basically, when you look at the network of the financial system, it becomes like so many CDOs being being produced. Okay, so derivative is something which is quite complicated, right, in terms of structure. So it becoming CDO1, CDO2, CDO3, for example. Okay, so it becomes it's not actually being backed up by the original, okay, the original asset, okay, but it was derived to another asset, okay, which is liabilities lah, okay, right. So when this happened, okay, for example, AIG, AIG, the business is actually insuring, okay, insuring the securitization, right? So it insured, but it does not have the money, okay, to pay, okay, whenever there is like the collapse happens, right? So that's why AIG collapse, okay. Lehman Brothers also collapse, okay, because of overexposure in terms of the risk that they are facing. So a lot of things happened. So many things happened during 2008. Market collapse. Okay, unemployment is very high. Okay, people losing their home. Okay, all right, but nevertheless, even the market collapse, um, it actually recover lah after some time. Okay, then we have another one which is in 2020 COVID-19, but still we need to learn something that over leveraging. Okay, over leveraging. Okay, and also what I call it, the having like a toxic assets, okay, as your primary asset is not a good thing to do. And one more thing is that I want to highlight is actually the rating agency. Okay, the rating agency, they are not, okay, they are not being what I call it, the rating agency is not being um sincere lah, okay, sincere. So they are giving rating triple A. Mana ada rating je tak ada rating. Triple A ni they are giving triple A, but actually it's actually based on toxic assets, right? And the most unfortunate thing is that all these rating agency, they get away. Okay, they get away. They said it's not their responsibility of what I call it, looking at the what I call it, the actual, okay, asset that they are rating. So whatever happened, okay, they are actually they only they get away lah from the problem. So it should not be that, okay. So this rating agency provide triple A what you call it, rating, and then get away because the asset is actually toxic asset. Okay, all right, all right. So this is a very interesting what I call it, what I call it, case, okay, where you can actually look at this, hold on, yeah, can look at this movie, okay, The Big Shot. Okay, I'm not really sure whether you have this movie in YouTube, but this one, okay, The Big Shot. So this is actually about the subprime crisis, okay. But this is not the full movie. This is only 8 minutes, okay. Probably I can, okay, the Big Shot movie explain. Okay, maybe I can share this one.
After watching The Big Short, a lot of people are confused about mortgages, shorting the market, and the main concept of the movie, so here's a small explanation. Now, in the movie, three groups of investment bankers are betting or shorting against the housing market. What this means is they are simply betting that the housing or real estate market will go down in value. So for example, if ABC Inc. is trading at $30 per share, $30 per share, but you think because that they have a bad product, maybe high insider selling, that this stock is going downhill. It's headed to zero. So you get on your brokerage account and make a trade to sell short 100 shares at $30 per share. So $3,000. You're basically borrowing the $3,000, so you're already in the hole if the stock goes up. Betting that the stock will go down in value. So the risks are high over here, but the rewards are also higher. So time passes by, a few months pass by, and ABC Inc. is indeed going down and declines to $20 per share. Now to take your profits off the table, you have to cover your short position. What this means is you simply buy back the shares at the current price, which is $20, and make a profit, $10 profit. So that's good. $10 profit off 100 shares is $1,000, including commissions. And this is what the three investment bankers essentially did. Bet against the market. Now, why would they bet against the housing market? Well, basically because of subprime mortgages. You see, when you apply for a mortgage, your loan usually gets a rating on how risky it is. From AAA to B and etc. AAA is usually the best rating you get, and it's the least risky, and most likely to make your payments. And then there's the most risky loans that are usually called subprime. Basically shit ratings. And the banks held debt to these loans. So what they did is basically bundle them up, gave them a total rating on how many AAAs, triple Bs, and Bs, and sell that debt. So as time passed, the bundles contained riskier and riskier loans due to millions of people taking on these huge mortgages that they can't pay back. Banks were basically accepting mortgages left and right. However, these riskier loans meant that they would be worth less. And banks want to make the same margins they were making before, so they lied about the bundles and said they were still high quality, AAA quality. Eventually, these bundles got so risky that they were worthless, leaving hedge funds and banks, investors all in the red. But who even took a bigger hit were the banks and institutions selling insurance on those instruments in the form of credit default swaps, or CDOs. They were on the liability end of huge amounts of credit default swaps. So they were deep in the red. So after the movie, you're probably still wondering who made money during this crisis. Well, the people who shorted the market, of course. They were smart enough to short the mortgage-backed securities before the market crashed and cashed out with a shit ton of money.
Okay.
And
All right. So at that time, okay, if you watch the movie, okay, basically, the one who short the market, they are making a lot of money lah. Okay. Short the market is actually you are selling. You borrow, for example, you borrow the stock, okay, and then you buy back when the price go down. So you make money lah when you buy at a lower price. Okay. Yeah. In Malaysia, we also have short, but it's only for intraday lah, for intraday. So you sell in the morning, you buy back before 5 o'clock, okay, for the stock market. All right. So this is the bond market. And then we also talk about the securitization derivative, okay. But basically, it is actually something that we need to learn lah. Okay. All right. So for the municipal bond, okay, municipal bond. Just now we are looking at government bond, right? Then we have municipal bond. Municipal bond is actually issued by local state, or maybe what you call it, local, municipal or state. Okay. So it's actually having the, what you call it, tax. You don't have to pay tax lah for the municipal bonds. Okay, you don't have to be taxed. It's actually tax free. So if you earn 10%, you earn 10%. Okay, you don't actually have to pay any tax on that. So this is what I call it, the municipal bond. But the risk is high because municipal bond is not the federal government. Okay, it is the state government. So they have a higher risk, okay, to default compared to the federal government lah, because federal government they can print money. Okay, state government cannot print money. Understand? Okay, contoh lah US federal they can they can print money lah kan. But for example California state, okay, Oklahoma state, okay, they cannot print money on their own. So there is a chance that if they are default, then you will lose the money lah. Okay, but it's not really what I call it, the thing lah for a state government to default, because normally the federal government will assist, bail out lah. Even in the case of the subprime crisis also, the federal government has bailed out AIG, Lehman Brothers, they try to bail out, right? So, and certain banks, okay, so about 800 billions, okay, has been used to bail out all these banks, okay? But that is actually taxpayer money, the taxpayer money. And then we have the corporate bonds. The corporate bond, we have three what I call it category, which is the asset backed and structured. Then we have variable and discount, and also speculative, which is the high yield junk. So the corporate bond is actually issued by corporation, okay, issued by corporation. For example, in Malaysia, TNB is a corporate, right? So it issue TNB bond, TNB sukuk. Okay, right. So we can buy the sukuk. Okay, basically this is higher risk as compared to the government bond just now. Okay, because corporate can default. Okay, corporate can default. Okay, there are also difference, okay, between the debt structure across the global. Okay, in US compared to Japan, Germany, and also United Kingdom, and also in Malaysia, right? And also we have this international bond. Oh, sorry, my battery is low. Hold on, yeah. Sekejap. Okay, we have foreign bond and euro bond. Okay, foreign bond sold in one country and currency by a borrower of a different nationality. So we have Yankee bond, Samurai bond, and also Bulldog bond. Okay, Malaysia last time we issued Samurai bond during Tun Mahathir time. Okay, Samurai bond. And then we also have Euro bond, underwritten by international syndicates and sold in several national markets. Okay, so this is the euro bond. So if you are uh, intending, okay, or maybe if you become fund manager, okay, you can actually go and look at these international bonds lah. Okay, all right. Okay, this is passing the terminal corporate bond codes. Okay, so we have this. This is issuer AT&T. Okay, this is telephone company in the US. Coupon rate is 8.1.2%. Maturity date is 2022. Okay, and this is the current yield, about 7.7%. And this is the volume, how many being traded at that particular day. This is the closing price, which is 105.375% of the face value. Face value might be 100. Okay, then net change from the prior day close is increased by, okay, 0 1/4, which is 25%. Okay, this is treasury and agency notes, agency quotes. Okay, and okay, this is for notes, right? So this the 30-second rule. Okay, unlike corporate, prices quote in 32 NDS. Okay, so they are the bid and ask. Okay, bid and ask. So this is bid, this is ask. Okay, but for Malaysia, okay, Malaysia, I'm not really sure. You have bid and ask. I think you have bid and ask. But for unit trust, you don't have bid and ask. Unit trust, you only have one price. Okay, for unit trust, you have one price, which is the net asset value. Okay, NAV. Okay, for bond, you need to check whether you have the bid and ask. Okay, but I don't remember because I'm not towards into bonds. Okay, all right. So this is municipal offering, so which is Indiana State. Okay, this is 200,000 face value. Okay, 200,000 the principal. This is zero coupon bond. Okay, backed by municipal bond. Okay, year to maturity is 5.6, and the offering dealer bears turns, whose contact info is in the publication. So this is municipal offering. Okay, now this is the agency, credit rating agency, Standard and Poor's, Moody's, Fish Investor Service, Duff and Phelps. Okay, so this is the thing that I've mentioned before. They provide the rating AAA. Okay, but actually, the rating should not be AAA. It's actually maybe double B, but they put AAA to attract people to buy the uh, the the what you call it, the assets, okay, or the bond. So all of this, okay, say I was saying just now, they say that they are not responsible for that problem. So they just get away. Okay, even though they are giving AAA towards a very toxic asset. Okay, but normally when we want to buy an investment such as sukuk or bond, we normally rely on their rating. Okay, all right. So any questions? Any question for this?
Prof,
Yep.
kalau macam individual investor like us, like we don't have any access, where can we find the what
Bond.
to trade the bond? Which
Okay, you can
platform?
go for small retailer. Okay, you can buy from Shango lah. Okay,
Shango. Okay.
Shango, but it's through a unit trust, if I'm not mistaken. Okay, so but that one is actually going for no, it's actually money market, if I'm not mistaken. touch and go. If you can open your touch and go and try and see. Okay, but if you want to buy, if you have money, okay, because buying the bond is actually require quite big capital lah. So you can go to these dealers. Okay, normally it's banks lah. Okay, dealers. So they will provide the what you call it, the become the agents lah for you to buy the bonds. Okay. Another way is going to you look at the Bank Negara. Okay, go to Bank Negara and then see how you actually can buy from directly from Bank Negara. But I don't think you can buy directly from Bank Negara. You have to buy from the what you call it, approved dealers lah, approved dealers, which is investment banks. Okay, that offer lah. Ni example you can go to let's say Bank Islam kan. Okay, Bank Islam. Um, let's say Bank Islam Investment. I'm not really sure. I'm just trying to find. Okay, this is fixed income. Okay. Okay, VIMB Malaysia Sukuk Income Fund. Okay, but this actually look more towards like the fund details is more towards like unit trust. 12-month term deposit okay. So the benchmark is this. So you can buy from here lah. So you see, unit trust. So they are giving the unit trust to manage the fund lah. Okay, but there is actually more 70% towards sukuk issued and then 30% Islamic liquid asset, which is money market lah. Okay. So we have 70% in sukuk, 30% in money market. So this is example lah, example. Okay, you can actually try to buy from here lah. The sukuk fund. Okay. Right, this is one example. Or you can go to Touch and Go, or you can go to Maybank, I think also have, okay. But you can also go to Bank Negara lah. Bank Negara, sukuk. So this is Bank Muamalat selling sukuk Bank Negara. So you can go to Bank Muamalat also. So this is bank trading, but I'm not really sure. You have to go to the key participant. So see the dealers. Okay. So principal dealers. So you can buy from here. Okay, the dealers.
Mostly the bank.
mostly the banks. Okay. Just now I want to show you. Okay, you can go to Bank Negara lah if you want to go and buy for the local market. Okay, for the local market. But you can also look at the investing.com here. Okay, under the bond market. Okay, under the bond market. Hold on. You can see where is the bond. Okay, this is the bond. US 10-year, US 30-year, US 5-year, US 3 month, US 10-year, Treasury note, Euro bond, futures, 10 to 2 year. So there are many, there's so many. Okay. The bond market is so huge. Okay, the bond market is so huge. Except that I don't actually trade in bond. Okay. Or sukuk. Okay, because the what I call it, the capital is quite big now. The capital is quite big. Okay. All right. So this is the bond market. Okay. In Tashango, I think under principal. Okay. Tashango under principal. Principal asset management, if not mistaken. All right. So today, okay, I am going to give a quiz. Take home quiz. You you to what I call it doing a take home quiz. Four quizzes. Each quiz is 10%. Okay, if you do not send the quiz, then you will not have the 10% because you don't have exams. Right? You don't have exam. You just need to do the assignments, the case study, the individual assignments, and the quizzes. So very easy, okay? Because you can do whatever, okay? Because it is actually take home quiz. All right. So for this week, to give you a question individually, yeah, hold on. Okay, the last 2 weeks, I think last 3 weeks, I sent you the first assignment, right? First quiz, which is looking at the how to calculate the portfolio return and also portfolio risk. Okay. Okay. The second quiz is regarding about fundamental and technical analysis. Okay. Fundamental and technical analysis. Okay. The last 2 weeks punya ni lah coverage. Okay. Bilanya. I'm going to send you the questions. Okay, you need to find, to analyze, okay, Yeah, I mentioned here Fang, but in the question is not Fang lah. So I'm just going to delete Fangs of US stock lah. Okay. All right. So you can discuss lah with your friends ke apa ke semua kan. Tapi but you need to send lah the the assignment, the quiz. Okay, I've already sent it to you. Take home quiz number 2. And I'm going to send also your individual assignment. The individual assignment, but this is actually not yet. You can actually work on it, but normally you have to go and understand about 2 or 3 more classes. Then you can. Right, hold on, yeah. Okay, the individual assignment should be sent. I think it's 1 or 2 weeks before we end the semester lah. So this is your individual assignment. Okay. This is also the example of how you want to do your portfolio assignment. Hold on. Okay. You get it? So I already given you the case study for group work, quiz 1 and 2, and your individual assignment. Okay. So you will have another 2 quizzes, quiz 3 and 4. Then halas. Okay. There's no final exam lah. So I know it's quite difficult if you go to final exam, okay? So final exam, if you go for face-to-face final exam, it will be difficult, right? Okay, but now it's actually you can do that now because you can always refer to your colleagues, you refer to the internet, artificial intelligence, and so on. Okay, but you need to understand what you are doing. So, any questions?
For second quiz, the due date bila, Prof?
Okay, second quiz. Normally for quiz, we have about 1 week lah. 1 week,
okay.
or because we have the third quiz, which is supposed to be okay. Jap. Okay, today is the second quiz, which is and the 1st of June we will have another quiz. Okay, so 1 week lah.
Okay, Prof.
So next after the Hari Raya, after the Hari Raya. Because next week is Hari Raya, right?
Yes.
Okay. Then we have a class on the 4th, okay? On the 4th of June. Okay. On the 4th of June. So you will have another quiz on the 4th of June. Okay. Then you will send your third quiz on the maybe on the 8th of June week, okay, which is maybe 8, 9, 10, 11 of June. Then you have another quiz on the 15th of June. Okay. For your individual and also group assignment, you need to send on the 29th of June. Okay, 29th of June, which is 1 week, 2 weeks before the study week. Okay, but you don't have exam, yeah? Don't worry about that. You don't have exam. All your marks will be on the continuous assessment. Okay. So for someone has sent me the what I call it, the group assignment. I want it to be sent on the 29th of June. Okay, please send again on the 29th of June. Just send the quiz 1, quiz 2, quiz 3, quiz 4. And I want everybody to send, because if you don't send one quiz, 10 marks will be gone. Okay. So one quiz is 10 marks, 4 quiz is 40 marks. It's actually the same as your final. Okay, it's actually the same as your final exam, but we don't do final exam. Okay, so we have, yep.
How do we know that the take home quiz that we have sent, how do we know that you receive it?
You don't know, right?
Oh.
Okay. Later on, I will actually put who has already sent, who haven't sent. But now I haven't actually I haven't done it yet. Just so busy. Okay.
Okay.
So
You,
I believe there are some of you have not sent. Okay. So you know who you are. Right. Some of you haven't sent your quiz. Okay, your take home quiz. So which is one quiz is 10% of your marks. So please do your work. So every week we have almost two. I mean, in 2 weeks we have not one quiz. So will have 4 quizzes, 1 case study, 1 individual what I call it portfolio exercise. So altogether there are 6. Okay, 6 assignments. Okay, 6 assignment, which involve 40% for the quizzes, 30% for your group assignment, and 30% for your individual assignment. So make sure lah, your 30% to according your answers to according to 30% lah. Okay, right?
Yang group assignment tu yang Prof bagi last week tu Prof?
Yeah. That one is
Tu
the
isi the
group
group
assignment.
Okay.
Yeah, that is the case study though. So make sure it's actually worth 30% lah. Okay. Okay, anything else? Ada? Okay, so there's nothing. So I think we will end the session. So I would like to wish happy Eid al-Adha to all. Okay.